As many of you know, I work very closely with my clients to balance out the amount of taxes they pay during their retirement years. See, in retirement, taxes are an expense. The more taxes you pay, the less money you have in your pocket. Now, the more taxes you pay doesn't in any way signify that you're rich. It just signifies that you voluntarily like to pay taxes. Because think of it, millionaires and billionaires are not working hard so they can maximize on their taxes, and neither should you. Now, there's an issue that has been cropping up lately. And these obviously is cropping up with people that are not my clients that have come in and see me. These are folks that hold a lot of investments outside of their 401ks, IRAs, and so on. And what's happening is we have the problem of mutual fund capital gains distributions, which actually happens every year towards the end of the year. Now, these distributions are catching people off guard and are leading you to pay higher taxes in April. Now, mutual funds make these yearly distributions of what's called embedded capital gains every year towards the end of the year. Now, these distributions comes from the buying and selling that goes on constantly inside of a mutual fund. And it also comes from people wanting their money. They call the mutual fund company. The mutual fund company redeems shares, and this causes capital gains, okay, in order, again, for you to get your money. So every fund, again, will distribute different amounts of these capital gains depending on a variety of factors. Now, again, this has always been an issue, but it's becoming a bigger issue now that the markets have performed really good. So in years prior to last year, there was a lot of losses that was continuing to be funneled over the years because markets were okay, but of course you know that we had 2008 and 2009 and places in between. So mutual fund companies were carrying these losses over. So the issue wasn't as prevalent as it is now. So those years are gone for many of the funds, and voila, you have a problem. All of a sudden, those losses are gone, and you have taxes. Now, here's the myth that I hear people say, well, if I'm paying on those capital gains on distributions, that means I made money. Well, your distributions in no way mean that you made money because most of the times you didn't. Okay, the value of the investment will actually adjust down by the amount of the distribution you are paying taxes on. For example, let's say that you hold XYZ fund. It's worth $10,000. In November and December, it has a capital gains distribution of $2,000. So now in January, or actually the next day after the distribution, you look at your at what the value of that XYZ fund is online or wherever, and it's still worth $10,000. Now, on the other hand, if you take your distributions in cash, your capital gains distributions in cash, an XYZ fund was worth $10,000. They distributed to you the $2,000 of capital gains distributions. And yes, you have $2,000, but the value of your XYZ fund went down to $8,000. All right. So you see how that works? Listen, we like to save taxes. All right. When you work with somebody like me, we're able to utilize planning, all right, to make sure that you minimize these issues and lead you to a very tax efficient retirement. Now remember, less taxes that you pay means more money in your pocket. Folks, and remember, a lot of that is right here in this book, in my chapter. So make sure to get it down below, and I'll see you next time on Financial QB TV.